Organizations and businesses present the results of their performance through financial statements. Before financial statements can be prepared, transactions are recorded, classified, organized, and indexed through various steps that make up the accounting system. The accounting system tallies events and changes to each account that either directly or indirectly impact the financial statements. These accounts are listed in the chart of accounts. A chart of accounts can be long and complex, especially for larger organizations. For this reason, account names are often associated with account numbers, which provide further clues about the type of account. A company may designate a few hundred account numbers for each type of account. For example, a liability account is indicated by the 2000 range. In this range, the first 500 numbers are reserved for current liabilities, and the second 500 numbers for long-term liabilities. Therefore, the account 2100 accounts payable is a current liability account. Having a few hundred spots available allows the company to add new accounts within that range. There is no limit on the range of account numbers. However, a business should not have too many accounts. Having too many accounts makes it harder to see the big picture and also tends to take a lot of time to maintain. Large organizations will often use a 5-digit number system, or something even more specific. For example, suppose a pest control company tracks sales by type and location. Their chart of account may have account 4000-0131 for sales, pest control division, California region. While each company will have a different chart of accounts, there are some accounts that appear on nearly all chart of accounts. Once a chart of accounts is established, each transaction impacts 2 or more accounts. Transactions will be recorded in 1 or more journals and in 1 or more ledgers. The general journal is a book or database where economic events are recorded by date. A transaction entry in the general journal is known as a journal entry. On the other hand, the general ledger is a book or database where economic events are recorded by account. Transactions are posted to the ledger. In all cases, transactions are recorded using the double entry accounting system of debits and credits. Remember that debits simply means left and credits means right. Whether a debit indicates an increase or decrease to a given account depends on the type of account. It makes sense to organize accounts to match financial reports, making it easier to create those reports later. The balance sheet represents the value, ownership, and obligations of a company. Within the balance sheet, accountants group accounts that are normally debits together as assets. Accounts that are normally credits are grouped as either liabilities or as equity if the accounts record ownership interests. The income statement represents the operations of a period that then add to or subtract from the earnings of the company. The income statement is split between sales, also called revenues, and costs, also called expenses. Revenue represents resources received or expected to be received by the company in exchange for goods or services rendered. An expense is the cost of buying materials, paying employees, or any other type of purchase in order to generate revenue. In short, expenses are the cost of doing business. Revenues increase through credits while expenses increase through debits. If a company is successful, revenues will exceed expenses, which means that the income statement will yield a net credit balance. This net credit balance will transition to the balance sheet as equity, or to be more exact, as retained earnings. This will cause equity to increase. This increase in equity will be matched by a similar increase in assets. If we assume, for example, that all sales and purchases are made in cash, the cash balance will increase hand in hand with retained earnings. Let's look at how transactions are recorded. Each account in the chart of accounts will have its own ledger or subledger account where all transactions impacting that account are listed. Suppose that Jim is an employee at a company and he keeps his finances using the double entry accounting system. This week, Jim has earned $299 in wages. Let's suppose further that he's always paid in cash as the service is provided. 2 account ledgers are impacted: wages earned and cash. Altogether, the debits must equal the credits. Under the double entry system, cash, an asset account, increases through debit entries, and wages earned, a revenue account, increases through credit entries. Let's suppose further a new business called Better Mousetraps Corporation starts operating through a $100,000 investment by its sole shareholder. The accounts impacted would be cash and common stock, each increasing $100,000. Under the double entry system, cash, an asset account, increases through debit entries, and common stock, an equity account, increases through credit entries.